If you've spent your entire life working hard, paying taxes, and building your nest egg, then this video is for you. We're going to be jumping into why required minimum distributions, known as RMDs, can quietly wreck your retirement plan if you're not careful. And we're going to talk about what you can do to avoid the damage. My name is Brad Pistole, and I'm a retirement income certified professional through the American College, dedicated to helping people retire all across this great country. If you ever want to see what me and my staff could do to propose a retirement income plan for you and your family, just reach out to us at the contact information below. Now let's get started with a question I hear almost every day. Brad, I've worked hard. I've saved for years in my 401k and my IRA. I've done everything they told me to do. So why am I being forced to take money out in retirement? That doesn't sound very optional, does it? Here's the deal. When you save in tax-deferred accounts, like traditional IRAs and 401ks, you're postponing the taxes. But the government doesn't let you postpone them forever. At age 73, under the current law, you're required to start withdrawing a certain amount each year from these accounts, whether you need the money or not. And every dollar you withdraw from a tax-deferred account is taxed at ordinary income rates. So what's the problem? Well, the problem is that these forced withdrawals often come at a time when you're already collecting Social Security. Maybe your spouse is too. And depending on your situation, you might have other sources of income like pensions, rental income, dividends, or annuity payments. And when you stack all of that on top of an RMD, it can push you into a higher tax bracket. It can cause more of your Social Security to be taxable. It can also increase your Medicare premiums. And in some cases, it can push you into something that forces you to pay IRMA surcharges, hundreds of dollars a month in extra costs. So let's take a look at a real life example. I had a couple from West Plains who came to meet me at age 72. They had done a great job of saving. Between the two of them, they had about $1.1 million in traditional IRAs. They had delayed their Social Security all the way to age 70, so they were getting nearly $70,000 a year combined from Social Security. They also had a small pension from his time working for a county highway department. Now, when their RMDs kicked in the following year, they were looking at about $43,000 in required taxable withdrawals on top of everything else. That pushed them into the 22% tax bracket. It made 85% of their Social Security taxable, and it triggered higher Medicare premiums. They were shocked. They didn't need that money. They weren't even spending all of what they had that they were forced to take out. But what about that tax bill? It just kept growing. And this is a situation I see over and over again. People who were told to put every dollar they could into tax-deferred accounts, and now they're being punished for it. Not intentionally, of course. But if you don't plan ahead, RMDs can become a real problem. So what can you do about this? Well, the good news is you have several options, but the best strategies need to be put in place before you turn age 73. This is what I call the window of opportunity, usually from the beginning of your retirement to your early 70s, when you're likely to be in a lower tax bracket and can take action to reduce your future RMDs. One of the smartest things you can do is implement Roth conversions during these low-income years. This means voluntarily removing money from your traditional IRA and placing that money into a Roth IRA, paying the taxes now on your terms at a lower rate, and never paying taxes again on that money. Roth IRAs are not subject to RMDs, and withdrawals from Roths are tax-free during retirement. Now, going back to the couple I've mentioned, if they had started converting $50,000 to $60,000 a year from their IRAs to Roth IRAs starting at age 65, their future RMDs could have been cut in half or more. They would have paid a little more in taxes early on, but they would have saved tens of thousands in taxes, Medicare premiums, and Social Security taxation on down the road. That's the kind of planning that pays off in a big way, and that's what we do for our clients. Another option is to consider qualified charitable distributions, known as QCDs. Once you hit age 70 and a half, you can donate directly from your IRA to a qualified charity up to $100,000 per year with inflation, and that money does not count as taxable income to you. For people who are charitably inclined, this is a powerful way to reduce your tax bill and to get rid of all or some of your RMD at the same time. Let me explain how this works. Let's say you're 75 and your RMD this year is $25,000. If you write a check to your church from your bank account, that may or may not reduce your taxes, depending on whether or not you itemize. But if you direct $10,000 straight from your IRA to your church as a qualified charitable distribution, that $10,000 is excluded from your taxable income. That's a guaranteed tax break, even if you take the standard deduction. Now, another thing to consider is how you structure your investments. If you're approaching retirement and have money spread across pre-tax, Roth, or taxable accounts, you want to think carefully about where the growth is occurring. If all of your growth is happening in tax-deferred accounts, those RMDs just get bigger and bigger every year. That's why we often shift growth-oriented assets into Roth IRAs or brokerage accounts that are more tax-efficient long-term. Here's one more point, and this is something many people overlook. If your spouse passes away and you go from filing taxes jointly to filing as a single individual, your tax brackets will be much smaller. But your RMDs don't go away. In fact, now the same amount of income might push you into an even higher tax bracket than before. This is called the widow's penalty, and it's a real thing. Strategic Roth conversions, while both spouses are still alive, can help lower that future burden. So let's recap. Required minimum distributions are not optional. If you don't take them, there's a 25% penalty. That's right, 25% on the amount you should have withdrawn. But just because they're required doesn't mean you can't plan for them, and that's the key. With smart planning, you can do the following. You can lower your tax bill, protect your Social Security from unnecessary taxation, keep your Medicare premiums under control, and leave more inheritance for your heirs. Because if you don't spend your IRA during your lifetime, someone else will. Don't forget this. And under current law, your kids have to empty that account within 10 years and pay full income tax on every single dollar. But if that same money is in a Roth account, they will inherit it 100% tax-free. RMDs don't have to wreck your retirement, but they will if you ignore them. The sooner you start preparing, the more options you will have in the future. If you want help running a custom RMD projection or exploring how Roth conversions could improve your long-term tax picture, just reach out to us. Thanks for watching, and we'll see you in the next video.